So, good day, everyone, especially to our teacher, Miss Michelle Aguilar. We are the group of Elijah and from the section of Isaac, and we are going to discuss the formulas and format in the preparation of budgets and projected financial statements.
Budget. A budget is a forecast of costs, revenues, and resources for a given time period. Based on assessment on future financial conditions and objectives, the budgets that must be prepared include the sales budget, production budget, operating budget, and cash budget. Sales budget. It gives an estimate of how much money a company will make depending on the volume of products it plans to sell in the future. So yung sales budget is, ito yung parang pagtatansya kung gaano karami yung pera nakikitain ng isang kumpanya depende sa dami ng produktong ibebenta ng company doon sa future o doon sa hinaharap. Formula. Sales revenue equals units to be sold times unit selling price.
Production budget. It calculates the number of units that should be produced for a certain accounting period based on predicted sales and the amount of any inventories that should be reached. It is estimation of the number of products that are to be produced by the organization over a defined period of time and also called the manufacturing budget. It is determines how much money will be spent on the entire film project. The production budget formula is required production in units equals expected sales plus target ending inventories minus beginning inventories. Cash budget. It shows the expected cash receipts and outflows for a particular accounting period. For a year, it is prepared on a monthly or quarterly basis. Cash budget, it is document produced to help a business manage their cash flow. A cash budget helps avoid a shortage of cash during periods. The cash budget is divided into three parts. 1. Cash receipts. 2. Cash disbursement. 3. Excess cash balance or required total financing. The cash budget formula is project sales per quarter times percentage of sales collection. Project sales per quarter times remaining percentage of sales collection. Quarter sale plus quarter after sale.
Projected financial statements are serving as tools of the company to set an overall goal of what company's performance and position will be for. And as of the end of the year, set targets to control and monitor the activities of the company. These following reports may be forecasted: projected income statement, projected statement of financial position, projected statement of cash flow. Projected income statement. The statement of comprehensive income is a structured financial statement that shows the financial performance of a business entity for a given period. The time period indicates the statement covers a month, a quarter, half year, or a year. Income is the summary of increase in economic benefits during the accounting period in the form of inflows or enhancement of assets or decrease of liabilities that result in increase in equity other than those relating to contribution from equity participants. Income statement, ito ang lahat ng mag-generate natin income from sales ng benta sa customers. Expenses are decrease in economic benefits during accounting period in the form of outflows or depletion of asset or incurrences of liabilities that result in decrease in equity. Expenses, ito yung nababawas sa ating company. Projected statement of financial position. The statement of financial position is a structured financial statement that shows the assets, liabilities, and equity of a business entity as of a given date. The term of as of given date indicates that the statement of financial position can be prepared anytime of the year. Asset. Asset are resource controlled by the entity as a result of past events and from which future economic benefits are expected to flow to the entity. Liabilities. Liabilities represent obligation of the entity arising from past events, the settle of which is expected to result in an outflow from the entity of resource embodying economic benefits. Equity is the residual interest in the assets of the entity after deducting all its liabilities. The financial position of a business entity is usually expressed in terms of its liquidity, solvency, financial structure, and capacity of adaptation. Liquidity refers to the ability of a business entity to settle its current obligations. Solvency is the ability of business to pay its long-term financial obligations. Financial structure indicates the amount of capital or resource financed by creditors and the amount provided by the owners. Assets equals liabilities plus equity. Capacity of adaptation refers to the ability of a business to invest excess available resources or raise needed funds through borrowing without difficulty in times of need. Projected statement of cash flows. The statement of cash flow is a financial statement that provides information about the historical change, inflows and outflows in cash and cash equivalents of an entity during the period from operating, investing, and financing activities. Operating activities are the principal revenue producing activities of the entity and other activities that are neither investing nor financing. Investing activities are the acquisition and disposal of long-term assets and other investments not included in cash equivalents.
So now let's move forward to the tools in managing cash, receivables, and inventory. Cash management is the stewardship or proper use of an entity's cash resources. It assesses to keep an organization functioning by making the best use of cash or liquid resources of the organization. Many businesses fail at the cash management, and the reason vary. Typically, a poor understanding of the cash flow cycle, profit versus cash, lack of cash management skills, and bad capital investment are the reason for failing at cash management. It is important for both companies and individuals as it is a key component of financial stability.
Cash management refers to a broad area of finance involving the collection, handling, and the usage of cash and available bank balances. Understanding the following cash management tools and techniques will help you better manage. Number 1 is basics. Accelerating collection of accounts receivable and stretching of accounts payable. Number 2 is the matrix. Dividing the expenses into priority and important matrix. Example, first important and priority expenses to be paid. Then important expenses. After that, priority expenses. Defer all unnecessary expenses. Speak to your vendor about the difficult situation. Most of them will understand your position and the current scenario. Number 3 is buffer cash. Maintain a minimum level of cash every time. This will be helpful in case of emergency requirements. Number 4 is non-fund based. Apply for the non-fund based limit from the bank. Bank guarantee given on a small charge. Many good vendors will companies will happily accept guarantees from the bank and be ready to defer the actual payment. Number 5 is gross cash burn rate. The burn rate is usually quoted in terms of cash spent per month. So the net cash burn rate, the burn rate is usually quoted in terms of cash spent per month after deducting the revenue from it. So number six is the runway. This show how many months may existing cash in hand will help me to run the business. The formula in cash in hand divided by net cash burn rate. Number 7 is float. It refers to the period that affect cash as it moves through the different stages of the collection process. While making my decision, take note of float. Mutual fund redemption through banks can take a float of 3 to 4 days times as they are working half the capacity. Number 8 is aging analysis. Age or period. Wise bifurcation of both debitors and creditors must be tracked.
And number 9 is look at your quick assets and quick liabilities, which is getting matured of payable in the next 1 month. This will help to forecast the current assets and current liabilities. And this look at your quick is need to do on a daily basis to update the financial statement. And number 10 is spreading out. Instead of giving payment in one shot, give payment in 3 to 4 slats. This will ease the cash flow of big payments without losing vendor confidence. And number 11 is cash forecasting. The same needs to be prepared day-wise, week-wise, and month-wise to keep a better track of the situation. And number 12, ask for a favor. If you are pretty sure that the vendor won't budge for delaying the payment, then ask for the extra discount or discount in the next cycle. Don't hitch, ask for the favor. And number 13 is credit cards. Small businesses owners are eligible for credit card but they don't use them. Now is the time to use them. Further, employees and related parties can also help the owner with additional cards. And number 14 is focus on cash. At the moment and not on the profit, after after a few weeks, you will realize cash is the king in bad market situations. And lastly is the unsecured loans. If you are running out of option, better to ask your bank for financing more if you have a good credit result, good credit history. And for takeaways and cash management is the process of managing cash flows and outflows. And there are many cash management considerations and solutions available in the financial marketplace for both individual and businesses. And now let's move on to the receivable management. The term receivables is described as debt owed to the firm by the customers resulting from the sale of goods or services in ordinary course of business. There are funds blocked due to credit sales. Um, the importance of this receivable management is to ensuring that customers pay their invoices because good receivables management helps to prevent overdue payment or non-payment. It is therefore a quick and effective way to strengthen the company financial or liquidity position. So one of the tools of the receivable management is the update credit collection. So this can be a valuable tool to ensure the sales of people and collectors are following best practices and procedures designed to increase sales while also protecting your company from bad debt. So um, this a credit And collection policy ensures that every collector is making the same decision when it comes to managing account. If one collector is allowing customers to go further past due than another, your account receivable department will suffer. So the next one is automation software. Um, just just because you have a credit collection policy does not mean it will be followed by your team, especially when it comes to collecting invoices. We're not saying company collectors are purposefully skipping over steps, but they may forget one or not have enough to take each and every step and every invoice. With with accounts receivable automation, you can build your policies and procedures into system. Now, collectors won't have to remember the steps and it will save them a ton of time. With account receivable automation, the system either automatically completes the steps in the workflow you've defined or prompts the collector to do so. So in electronic invoice delivery and payment, if you're currently managing the billing and the collection process with the paper, its time kicked this to the curve in 2016. Snail mailing invoices and waiting for customers to receive them, process them, and return the check can add many days to invoice cash process. And further, it opens your customer up to fraud risk. Electronic invoice presentment and Payment Solution or EIPP allow you to submit invoices and accept payments from customers online. This such as GCash, Paymaya, or any online banking. This technology makes collecting payment from customers much faster, much easier, and far less expensive than traditional paper-based process. And lastly is the customer self-service options. More than 70% of customers, especially small and medium-sized business customers, prefer self-service option like an online portal compared to phone or email support. Can we blame them? Because everyone is busy and nobody wants to waste time playing phone tag or waiting for email responses strictly during business hours. You can give them this control with an online portal where they can log in to retrieve invoices, pay bills, ask questions, and view payments. And also chat with the support representatives, and um, more 24/7 by granting customers and control and convenience they want. You can significantly increase on-time payments and customer satisfaction. And that's all.
Here are some of the tools that can and should be integrated with inventory management to give you the control and visibility you need to support efficient operation. Number one is the barcode data collection. Manual reporting can be plagued by delays, errors, missing transactions, and undue burden, and the workforce to collect and enter the data. Automated data collection, most often through barcode scan, remove much of the reporting burden while greatly improving accuracy and timeliness of transactions. Barcode data collection, it helps the business to avoid processing errors. Number two is the cycle counting to improve accuracy. Cycle counting replaces the cumbersome and error-prone periodic, usually the annual, physical inventory count with a regular program of counting selected items so that more important items are counted more often than less important ones. Cycle counting to improve accuracy, it helps you to prioritize the products that have the highest value or usage. Next. Number 3 is the ABC analysis for prioritization. Cycle accounting is usually set up using ABC analysis to identify the more important and less important items mentioned above. The most common ABC analysis, also called Pareto analysis. Pareto analysis is to observe the problems and determine their frequency of occurrence. It gives us the information we need to prioritize. Pareto analysis show by using bar or line graph. Um, ABC analysis for prioritization is divided into three, which is the A, the B, and the C. Ang nakalagay sa A, which is the items with are very important for an organization. Next sa B naman is items are important but of course less important than A items. And C is it is the simplest controls possible and minimal records. Next. Number 4 is integrated planning and execution. The primary focus of ERP is to improve customer service or the meeting demand while optimizing resources including inventory and reducing cost. ERP is enterprise resource planning. It is to increase organizational efficiency of an organization by managing and improving how company resources are utilized. And last, the lot tracking and traceability inventory tracking is a requirement for financial control and basic business management processes. But inventory management and inventory data can be a valuable resource in the quest for performance improvement, higher level of customer service, cost control, product development, and overall business success. Lot traceability is a group of goods that were made together in the same manufacturing run and produced using same materials.
To summarize it all, we report about formulas and format in preparation of budgets and projected financial statement. Sales budget. It gives estimate how much money the company will earn depend on what they are planning to sell in the future. Product budget. It calculates how much product to be made based on predicted sales. It shows the expected amount of income to a company in a particular accounting period or a year. It also has three parts: cash receipt, cash disbursement, excess cash balance or required total financing. Projected financial statement. It's a tool that company uses to set a goal for the company's performance. It monitors what activities are the company doing. We also talk about tools of managing cash receivables, and inventory cash management. It shows the collection, handling, and usage of the available cash balances in bank. We also talk about the technique that can make you better in managing. Some of the tips are basics, the matrix, buffer cash, credit cards, focus on cash, and many more. Receivable management. It's the debt owed to the firm by the customer resulting from the good service. Update credit and collection policy. It's a tool to ensure sales people that are following best practices and procedures to increase sales. Automation software. It's a tool that helps to not overstep or forget one or not. They are short in time to take each and every step. Every invoice. Electronic invoice. Delivery and payment waiting for customers to receive them and return The check can add many days invoice to cash process. Customers self-service option is like an online portal compared to phone or email support. We also give some examples of tools used for inventory management. Those are barcode data collection, cycle counting, ABC analysis, integrated planning and execution, and